Okay, so welcome everybody. And today I wanted to share some stuff that we learned this week in my conversation with um my CPA. I wanted to share with people like how you can what does it look like as an investor in real estate deals? A lot of people don't actually know the entire process. Like from the time that you invest into a deal, right, to how do you start to structure your own self into a way that you can begin to not pay any taxes? And so we had an extensive conversation with my CPA today, in our mastermind call on Tuesday, with our team, with the Legends Mastermind. I wanted to just kind of share this, what we've learned through there with everybody here on this call. And we'll kind of go through like how do you underwrite a deal in 5 minutes? That way you can go through and look at 30 deals a day, 40 deals a day. And then obviously to and how you can get started, right? Because I think I was getting very clear on my avatar, like who are the people that I'm looking to help. And I think, I can help people that have not done a deal. I can help people that have done a deal, any of that level. But I really want to focus on helping people get into their first deal. Because I think there's so many people that are teaching concepts already, right? So we can do concepts all day, but until you're actually in a deal, none of that stuff will really, really land and stay with you. So I want to like help everybody get into their first deal. It doesn't even matter what size, because you can transfer the lessons that you learn in a single family deal to multifamily deals, because you can start to relate and understand, oh, there is operating expenses. Otherwise you're just learning the concept of operating expenses. Otherwise you're just learning the concepts of submitting an LOI and that whole process. But how do we actually get that and put it into action? I want to start to move and become very intentional on delivering that, right? Like, because so many people are like, I want to learn how to do this, but this information is everywhere. The learning part of it is literally 5 to 10% of the game. The other 90% is what action steps can I take now to move the needle forward for myself every single day? What can I do every single day so that I can get that first deal done? And so this call will start to be very intentional, moving into how do we get the first deal done. And so this is going to be the invitation is get engaged. If you have not done your first deal, then start to ask these questions, because I'm bringing my mind to as beginner level as I can be. And the way that I'm doing is I think about a person, right? Like, and this person is on this call. I think about this person. I'm like, how does this person get into their first deal? How do they get it going? And this can relate to everybody else that's got a deal going. How do you get your second deal? How do you get your third, get your fourth? Or it's the next size deal that you've never done before. Maybe you've done a bunch of single families. How do I do my next one? The lesson of getting into your first deal, or maybe let's not call it the first deal. The lesson is going to be, let's get into your next deal, whatever that looks like for you. Okay, maybe it's the first one, maybe it's your 10th one, but either way, like, next level. What's the next level for you? So I don't know how much experience everybody has on this call, but I do want to serve everybody. So this is going to be more of an engaging call. I like that there are so many conferences happening today. So everybody is everywhere. It's probably be a nice intimate session, right? People are in Dallas at Michael Blank's conference. People are in Atlanta at the multifamily, whatever other conference that they got going over there with all the brokers and realtors and all that. So everybody's everywhere. This gets to be a nice intimate session. Hopefully, as I'm saying this, probably like 60 people are gonna join. But first, I want to start with taxes. Okay, like the benefits of taxes. Let me see if I can get my iPad on here and just begin to share. Um, iPad. a plugin is required. Okay, downloaded it. Good. That took 1 second. Awesome. Because here's the thing, the next real estate deal is going to be great for wherever you are at financially. It's going to move you forward. Mirror. Zoom Mac Mini. Come on. Nick isn't here with me right now. I can do this. I can do it. All right. So you guys see my little black screen? Everybody sees? Yeah? Okay. All right.
Fine.
So, yeah. Okay.
Just say I can do it and you'll be successful. You got
it. Yeah, thanks. So tax benefits of real estate. This is like people pay too much taxes. I got a friend in the MLM business, and he paid $600,000 last year in taxes. And it's just like, it really hurts me to see that people don't have to, and they do. My CPA is a full-time accountant, and there's no way that he could be a real estate professional, but his wife is. So first, I want to talk about the difference between a real estate professional and somebody that is not, and the benefits of that, and why we can, if we understand this, we can actually understand how much time we should put into our W-2 jobs. Okay, so real estate professional, it's funny. Me and Brent joked about this. My CPA is that we should have a, you know how people have like doctor or MBA or something like that behind their names. Real estate professional should be one, but it's not. It's literally just a checkbox on the IRS form. But you do have to meet certain criterias. So at very minimum, you need to do 750 hours, okay, of real estate related things. Okay, things that are moving you forward to buy your first deal, okay, or you're studying to get the first deal. You can even make a case that you're reading a book, okay, to get your next deal done. So those hours can all be in. There's a lot of gray lines. Now, of course, it says it's got to be a part of acquisition. It's got to be a part of management. It's got to be a part. There's a couple criteria that the IRS puts on there, but it's very, very gray line everything. Like, what does it mean? What does acquisition mean? Like, I'm looking at deals. Okay, that counts. And then sometimes, well, if you're not doing anything, it doesn't really count. So the goal is actually to get into your next deal. Get into a real estate deal. This will help you not get audited. All right. So that's the first criteria is yes, in 750 hours, that's about 2 hours a day for the year. So it's not really that hard. The second thing is it needs to be 50% of your current work. Now, like, if you work, like if you have a W-2 job, that requires 1,500 hours from you, that means in order to be a real estate professional, you also have to put in, to be a real estate professional, RP, you also got to put in 1,500 hours in deals. Now, what you can do is for your job, even though it's a W-2 1,500 hour job a year, you can take out about 1 or 1.5 hours out of that job during your lunch break, right? That you're technically not working there, but you can say for 1.5 hours out of my working job, my working hours every single day, 5 days a week for the whole year, I can take those hours and add it to my 1,500 hours in real estate, because what I'm doing at lunch is I'm either looking at deals, I'm emailing brokers. Like, those are times that you can add on there. Now, you also, if you have a W-2 job, what you want to do is you want to create a spreadsheet tracker. Okay. Something that tracks your hours that you're doing. And then before you file your taxes, make sure your CPA also gets to see this tracker that you did, right? I spent X amount of time here. I went to this conference so that I can position myself to be, to purchase my deal. Now, it's pretty important that if you claim real estate professional, that in that same year, you get into a deal, whether it's an investment or you buy your own rental property or whatever. It's about everything is about getting into your first or your next deal this year, your first deal this year. You can invest in the deal, you can buy a deal, whatever it is, you need to have something on your tax papers to help the case in the event that you get audited, because first they will look at is your do you have a W2 job? I was asking my CPA, I was like, "Hey, do I need to do any of this stuff?" Like there is no doubt that all I do is real estate, right? I teach real estate, all the stuff. And that's what I do. But would they audit me? They're like, "No, you don't have a W2 job. All of your money basically comes from either coaching, real estate, or doing real estate." So they're not going to question you. I'm like, "Okay, cuz I don't feel like tracking my hours." But why is it important to become a real estate professional? Okay, Caroline, go ahead before I answer that question.
Thank you. I have two questions. One, I don't have a W-2 job, but I have income. So the 50% applies to our income?
No,
50% of our income has to be from real estate activities?
50% of the hours.
Oh, that I put into everything. Okay.
Yeah. So if
Okay.
you don't have a W2 job, they're not really going to be tracking your hours for your W2 or what your other work is. So that's up to you in the level of your own integrity to do it. But you spend a lot of time learning already. Your education on this is big, and you're invested into a deal, right? You've invested into our deal, and that's going to show that, hey, I've put all these hours in so that I can get in a deal, and I did get into a deal.
Okay, I have another question.
Yep.
And it is, I invested early in the year. I was learning at the end of last year and this year, and I will continue to learn. So does timing matter? If I invest first and learn and
No, they're not gonna, as long as you have, like, if they look at a paper, they don't have that much time to go through your paper. All
okay.
right. They're like, okay, well, she's in the deal. She's obviously in real estate. She doesn't have a W2 job and she's a real estate professional. Okay, good. Next. It's
Okay.
only when you have a W2 job is where they will start to look a little bit deeper. Okay.
Thank you.
Yeah. And now what is the benefits of becoming a real estate professional? All right, here it is. You're being a real estate professional, you can deduct all of your income and your spouse's, right? W2, capital gains, any sort of income that you have. And I'm going to draw out a couple scenarios in which this is really important, including when you are about to pull out your 401k or IRA, right? Because you're going to be taxed at a certain level. By the time that you pull that money out, and they're going to tax you on that, on because they're going to count that as your income for that year. So based on whatever your income is, if you're pulling out $400,000, they're going to tax you on whatever gains you made in your 401k at that, whatever that income level is going to be. Even if you are retired and you don't no longer have a job and it's your tax bracket should be low, it could be high based on what you're pulling out. Now, if you are a real estate professional, all you have to do is in the same calendar year invest a certain amount of dollars into a deal. So basically, what it will most likely look like is every $100,000 that you want to write off, you will need to invest somewhere around 140 to 160K. Okay, so that you get on that year, you will receive a K1. You will receive a K1 on that calendar year of your deductions, and then you can deduct it against that. But only if you're a real estate professional. If you are not a real estate professional, what you get is you get a deduction of your passive incomes. All right. Only. But it carries on year after year. So I'm going to give you guys a quick example of a journey of investing $100,000 into a syndication deal, which, let's say, the first year, year number one, and this is we're going to do a non-real estate professional and a real estate professional comparison. So this is going to be a non-real estate professional. You're going to invest 100K into the syndication. Year one, you will get a K1, let's say of your K1 is going to have a negative $60,000. Okay, somewhere around that. So, and your distribution is, let's say, I don't know, $5,000, 5K. All right. You can only deduct this 60K from this 5K income. Okay. And let's say you make another $200,000 from your W-2. All right. You can't deduct anything against that. However, the other workaround is if your spouse is considered a real estate professional, we can deduct off of your W-2 income. Now, let's just go down a little bit. Go down to year two. Let's see, you still get 5K. You get a little more deductions. I don't know, 10K. Year three, 10K. Year four, 10K. Now, everything that you don't use from your K1 rolls over year after year after year. Okay, and let's say we sell in year five. Okay, year five, we sell, you get, I don't know, $200,000 out, 200K, right? Because we're somewhere around 2x your returns every 5 years. That's pretty conservative and simple for people to do. And so you got 5K each, averaged out each year before. So you had $20,000 in which you didn't have to pay taxes for, but you got $100,000, or you got 90,000, 80,000, whatever it's really going to look like based on the GP LP splits as well. You still have like $70,000, okay, in your that you can write off. You still have a negative 70K. When you sell this deal, right, you've made on this money $120,000. Your capital gains here is a total of 120K. Everyone following? Right, you invested 100,000. Your exit was an extra 100K, plus you made 5K a year before that. So your total capital gains is 170,000 on this. Now, being a non-real estate professional, this is actually really, really key, okay, in the taxes. And people, I don't think anybody teaches this or even says anything about it, is that you can take this 70K of passive, this is your passive loss, right? Because you're a non-real estate professional, it's considered your passive loss. You can actually apply this passive loss to your capital gains of that specific deal. So really your capital gains right here is 50K. All right. Now, what we could do as a deal is, hey, let's 1031 exchange this whole thing since you didn't use your money, or if you did, if everybody used up all their money and we're like, hey, as a group, do you guys want a 1031 exchange into another deal? We can't do partials, right? But if one person's like, hey, I don't want to, you can sell out your position. Okay, you can sell your position out, allow somebody to carry that over. There's some tax incentives for them to do that as well. You may have to sell your share, 100K share for, I don't know. In this case, it might make sense to take out 80,000, right? Or 70,000 so that your capital gains is much lower. But you can sell your shares. You're like, I'll take my 70K and, you buy me out and then you guys roll into the next deal. So that's a possibility for a 70 cents on the dollar. People will do that all day. Okay. Because that just gives you a higher position to the next deal. Now, Everybody clear on this non-real estate professional? You can take the 70,000 and deduct it from your capital gains of the same deal and give you only a $50,000 capital gains. Yeah. This is why now I'm going to show you what a real estate professional looks like on this. Okay. And which will be pretty interesting. What you want to do is in your time in this 5 years, somewhere around your 5th year before you sell, you want to really begin to have that professional real estate professional box checked. Because what you can do, the difference here for a real estate professional on the same exact scenario, let's say your entire K1 of $85,000, $90,000 of depreciation was used up. You used it against all your other income. And by year 5, you now have the full 120K that you have capital gains on. Okay, so on this, we'll have, by year 5, you sell the deal, same scenario. You actually have a true 100K, 120K capital gains. As a real estate professional, what you can do is on year 5, you don't need to do a 1031 exchange, nothing. All you have to do is go and put 150 to 180K into another deal, and you get your K1 for year 1. So this is deal number 2. On year 1 of deal number 2, which is the same time frame as your exit on year 5, it's the same time. You invest into your deal number 2, and you get a K1 of negative 120K. And that can offset your capital gains. You can roll a second deal depreciation into your current capital gains. All right, this is what I want to do for people that invest. Is I want to not only help you invest into a deal, but I want to help you not pay taxes on any of your gains. There's no reason to pay taxes. Now, along the way, there might have been a refinance too. Then you got some other money out, and that's also tax-free. All right, so this is the difference right here in real estate professional and none, and then non-real estate professional. It's literally on this scenario, 50K of capital gains. Just simple. And this is a small, quick example. Now, when this money gets bigger and bigger, and it'll look different, right? And you'll want to consult with a real estate CPA that will help you strategize as you're moving into it. And one of the things that we do want to stress is if let's say we are selling a deal towards the end of the year, like if we can extend and push it to the beginning of the following year, it would be ideal. Right. But now, of course, when you sell, you don't really want to mess with that too much, because then things may change and markets may change, and all of a sudden you're trying to hold down, you can't get what you were going to get. So we don't really want to mess around with that, but we would ideally want to sell our deals towards the beginning of the year, not towards the end. Now, if there are a lot of other deals lined up at the end of the year that you can get out in November and get in another deal in December, boom, do it. This is actually why I was able to raise $1.9 million in 10 days last year. I wasn't 100% sure what was going on, why everybody just needed to throw their money into some deals. I knew it was like, oh, it's end of the year, we need to get depreciations, but it's because a lot of people exited properties that year and they just really need to put it somewhere. So by the end of the year, they're like, oh crap, we just talked to our CPA, we just strategized, and it needs to go somewhere. I saw people posting, anybody have any deals closing by the end of the year? Any deal. Like they didn't even care what the returns were. Because it doesn't matter what the returns are as long as otherwise you either give money to the government or you put it into a deal that, like, hopefully, you land on a deal that has a good operator and you don't lose the money. But at least you're not going to give a huge portion of that away right away. So what we are doing by not paying these taxes is we are able to reinvest, so tax money that goes to the government. Instead, we're able to reroute it, and this is why IRAs are great and 401ks are great to invest with, is because you don't got to pay the taxes till down the road. So you can take the tax money and go and make more money instead of giving the tax money away. You have more power to keep doubling and playing that game because you don't have to pay the taxes till the end of the year. That would be why I would suggest people, invest through that. But if you understand the game of being a real estate professional and and actually being a non-real estate professional, you still can get great deductions through real estate. See, I don't think everybody really fully understands that. People are like, oh, you have to be a real estate professional, or how people are even making, taking the tax advantages, right? Because not only do you have, when you can become a real estate professional, here's the other thing. Okay, being a non-real estate professional versus a real estate professional. You buy Grant Cardone's real estate club, 25K, okay, to join that club. A non-real estate professional can't really write this off unless they start an LLC that has to do with real estate. So what does that look like? I don't know. I'm an advisor. I'm a property manager. Property management, right? So something to do with real estate. I'm going to teach it. I'm a mentor, coach. Now you can write this off sort of towards it. But if you're a real estate professional, you just take this just becomes a deduction for you because it's a real estate focused mastermind, a course that you bought. And so for me, as a real estate professional, I had $165,000 last year of masterminds and courses that I paid for. Okay. I also had a pretty good year of 750K of income. So I can just write all this stuff off immediately. Then, of course, I had to figure out how much money I had to put into all my different deals so that I get the K1 deductions. And I had to talk to Brent. I'm like, okay, so this is how much I'm making. This is how much we can write off. I also have an S corp that everything runs through, so I can write off all the expenses. I fly to Florida. That's on the expense sheet, right? And maybe I spend a little time on real estate over there. Any hotel that I go to is on that sheet for me because on any time that I go to a hotel anywhere, I'm probably doing some calls on Zoom somewhere. Right. So those are all write-offs for me. And now I got these write-offs, and I don't even have to I don't have to make up write-offs. I just take those, and then I also take my depreciation. And then at the end of the year, for somebody that makes 750K that doesn't know this, they're gonna dish off $250,000 to the government. Right. And then we said this scenario. This one scenario is $100,000 doubling every 5 years. Okay. This equates to 26.5 million in 40 years. So if I just gave $250,000 to the government, what am I actually giving up in opportunity lost? $50 million, $60 million, right? For my future when I'm 70 years old, because I gave up 250,000 this year because I didn't know any better. But because I do, because I was taught this and I have the right professional team around me to help me do this, that's the difference right there. People don't understand how big of a difference it is when you give money to the government when you don't have to. Then we look at, all right, that opportunity cost is $50 million. And if I keep my W-2 job so that I can keep making an extra, full time, so I can keep making an extra 30,000, 40,000, it probably doesn't even work out. If you work a W-2 job full time W-2, and you make 100K, right? You're probably going to pay $30,000 in taxes, 25, 30,000. You take home 70K. If you did part-time W-2, let's say you do 60K, but you're also a real estate professional. You pay no taxes, 0 for taxes, and you keep 60K. But you also, all right, so it's a difference of 10K, and I'm just throwing a random example that's just out of my mind right now. But you also got back half of your time, which is what we want. I'm pretty sure if you took half of your time from your W-2, you can make an extra 10K doing anything. Right? And then you get to spend more time with your family. You get to start investing more into real estate, learning more about real estate. At the time conversation, you start to gain that back. So everybody gets to do their own math. Hey, if I took away full time, maybe I lose some benefits here too. But is it worth 750 hours of my time for the year? Right? My full time, 1,500 hours. But when part time, maybe I work 900, but I get 700 hours back for the year. What can I do with that 700 hours? Like now that becomes a thing. And if you're a part-time W-2, you don't really get questioned too much about being a real estate professional on your tax returns. All right. So I know I said a lot. I hope everybody was able to keep up. I try to keep it as simple as possible. Anybody have questions, comments?
Hey Alex, it's Liba.
Hey, Liba.
Hi, that was a lot. I got some of it. I have a few questions.
Yes.
Does it matter if 1099 or specifically only the W-2?
So 1099, you're an outside contractor. So it depends. It depends. They're gonna look at how much money you make doing it and how much time you actually do. Like, are you like they'll ask, but it's really specifically to W-2 that provides the biggest challenge. You get flagged automatically if you're a real estate professional with a full W-2 job.
And can you backfile as a real estate professional, or you had to have owned property?
No,
You
you
had to
cannot
have bought.
backfile. You can't backfile real estate professional. You got to file it this year for this year. You can't
Do
say,
you
oh,
have
last
to?
year, huh?
Do you have to have bought property to be
It
a real
would
estate
help your
professional?
it would help your case. The other thing that can help your case is you talked about getting a real estate license. Right. So if you got a real
Yeah.
estate license or a mortgage broker license or some sort of license that has to do with real estate, then you'll most likely be qualified and they won't question you as a real estate professional.
I'm asking for last year
No, last year
because but I didn't file yet.
oh, okay.
Uh,
So
he filed an extension for me.
yeah, that's good, but this is I think you have to honestly be able to say to yourself, yeah, I'm a real estate professional. Right? Otherwise, I feel like it'll just come back and bite you in the ass if you're just trying to make some stuff up. So I would like this year be like, all right, last year's last year. This year, I'm really going to dedicate to it. That means I got to spend 2 hours a day. 2 hours a day. Alex, what can I do with you for 2 hours a day? I got plenty to help people out to do 2 hours a day. We're going to actually hire a bunch of interns over the summer of teens to build up something, to do real estate stuff and give them partnerships when deals are done. So, yeah, I wouldn't go back to last year and say I'm a real estate professional when you really aren't. But this is I think it's important to like live in integrity ourselves, like that we can say, yep, I'm not trying to get one by. something like that. So does that help?
Okay.
But
Yeah. I
you can
mean,
make a decision this year to be like, I'm not paying any taxes because I'm gonna be a real estate professional. I'm gonna
I'm
get into
not.
a deal. And then we'll talk about that next. Is like, well, I don't have money to get into a deal. What can you do? All right. So we'll talk about that. Go ahead, Carolyn.
Um, okay. Uh, what if we get, I mean, we have 6 months left in this year and I don't have half of 750 yet that I put into looking at deals. But if I put that time, as much time as I can later in the year, and I get a real estate license, but I don't sell a lot of houses, does that matter? I mean, as long as I'm putting my time into real estate, looking at deals, and I just happen to have the real estate license, does preparing for that or taking the classes for that count?
Yeah, it all counts. So like that's really 4.1 hours a day.
Okay.
Like if you were gonna go and do the whole 750 in half the year, you can. That's not that much. Right? It's like really not that much. Like we work 9 to 5, which is what, 8 hours, 8 hours times 5 times 4. That's 160 hours a month in our full-time jobs times 6 more months, like 960 hours, for a full-time job that you'll still have for the rest of the year if you have W-2. So it doesn't matter when you get it. I mean, you still got half the year, just spend more time doing it. And you spend a lot of time. I mean, I think that's 2 of my calls a day would make 4 hours a day. Yeah.
Great.
And yeah, and if we start underwriting, we start doing more things like, that it would be a lot of hours. It's a commitment thing for us.
Yeah. Okay.
Yeah.
Okay. Thank
So,
you.
yep. Somebody else had a question?
Yeah.
Hey, what's up, bro?
Okay. Pinya here. Question about all that we spoke about. It's a lot. It's a lot to digest over here to break down. I'm looking at as a teacher in the school during the day. If it pays, number one, to get the professional license, what would it take for that? Because I am subscribed to specific courses in real estate, but I don't know if they give you some type of license. And number two, if it pays for me to get out of that job and put myself all to it, and not get stuck when I deal with certain paperwork and they need to know my W-2 or something, like what do I do? So I want to make sure I set myself up properly.
Yeah, being a real estate professional is not a license that you have to get. Being a real estate professional is a box that you check with your CPA on the IRS form.
That's all it
There's
is.
nothing else to it. And most of it, they're not going to question. As long as you look like you're doing real estate and, you get a deal going. That's the most important thing. Just by doing one deal, people can spend 750 hours trying to get one deal going. Totally. All right, we got this one deal that we're working on. Spent way more than 750 hours on this thing already. All right, so yeah, you can, but the goal is, how do I get my deal done? So at least I look it on paper, even if I'm claiming it too. Now this is just a real estate professional conversation, and you're trying to offset income and not pay taxes legally. That's the important part. Like, it's not just like we're gonna do it just to make some stuff up, or if you had no income at all, like that's probably the first thing to focus on is let's build income and at the same time be a real estate professional, right? Like that would be ideal for everyone.
There's no official license. Interesting.
No, there's no license. Now, a real estate, realtor license, that's something that can help your case too. So
what is that all about?
Huh?
What would that be all about?
You got to read this big fat book. You got to go to these classes, and those all count as hours, by the way. Then you got to pass the test. Then you got to pay money for somebody to put you in their brokerage firm and pay for a bunch of other stuff. so that you can start selling and listing real estate. And it's not super easy thing. You got to also be committed. Anything that you want to be great at, you got to commit. And you have to be able to go through a period of time where you're going to have nothing, right? Unless you got a community that you're a part of. Maybe you're in a community and day one you can get a deal sold. That's why network is the most important thing. This is the thing, when people become realtors, then they realize how important networking is, right? Like, do the networking ahead of the game, ahead of whatever you want to do, because if you have a network, anything you do will just more likely become more successful quicker. Right. So, or you can act as a referral agent and skip the whole payment to the boards and all that, which, my buddy does. But, I just feel like if you're going to do it, just do it all the way. Like, don't try to skimp a little bit of money so that you lose out on a whole bunch of money more. And that's another thing. People leave big money on the table to take small money. Like, everybody kind of does that because you got to be able to see longer out of the longer, like in time frame. In time, you got to be able to see further out. That means I'm not going to leave big money on the table. I'll leave little money on the table so that I can get the big money. And that means I might have to put my money in and pay the referral or pay the payments to the boards. Like, let me be a real agent. Let me be listed as let me be a part of the association. I don't know, whatever all the terms are for being a real estate agent. But, I know there's a whole bunch of stuff, right? You could be on a board or association. You could be a part of different brokerage firms. I think, EXT's got, or is it EXT? Is that what it's called? EXT? Is that the new kind of like MLM brokerage, realtor brokerage thing? EXP. There you go. EXT. I knew it was off a little bit. Yeah, I know people in EXP that are making 6 figures a month, not selling any real estate right now because they put in the work. They came in early, and they got a whole bunch of people under them. So there's all these different ways. But again, networking.
What about the GPLP thing? I heard you can do that only with a license or so.
No, so you don't need any license to do syndication, real estate, multifamily syndication. But I mean, I don't know. Maybe in the future people should. I don't know, because I don't know. I have no judgments against that, but there are a lot of just messy ones. And if people do it without the proper education, and when one person screws up, it makes the whole industry look bad too. It makes other people look bad, right? When everyone's seeing the guy in Houston just falling off the face of the earth, and all of his deals, he's just abandoning it, and Arbor taking one back after another, that doesn't look good for all of us. It gives financial advisors ammunition to say, don't invest in real estate. It's dangerous. When Wall Street writes an article about all this stuff, about, I think it was crazy. They linked Brad Sumrock to it, Grant Cardone to it. And, those are kind of, it's just bad across the board, all for everybody involved, so I don't know. Side conversation, I guess, tangenting. But anyways, Josiah, go ahead, man.
Hey, great topic, Alex. Thanks.
Thanks.
When you talk about deal, does becoming an LP in a deal counts towards that? Would that make my case stronger?
Yeah, being an LP, because you're an investor into deals, like that requires studying, that requires time to evaluate deals, being on calls, listening to, deal pitches and all that. You're doing your due diligence. Anything that has to do with due diligence can count towards those hours, because you're a real real estate investor at this point.
Yeah, I guess I would also say if you become an accredited investor, that would help also in that case too then.
Maybe, because accredited investors doesn't have to just do a real estate. There are businesses that are accredited investors only, and there are all sorts of investments that are accredited only.
Very good. Thank you.
Yeah, you're welcome. Good question, though. Being an accredited investor just makes you a little bit cooler, I guess. A little more knowledgeable. It's true. Usually people that are accredited investors, they've invested multiple times. Being a non-accredited investor, so this is something about doing deals. When you're doing deals that are taking non-accredited investors, you are going to have to educate them on why invest, period. Accredited investors do not need your education. They just need to know what the deal looks like, what their returns look like. Are you a good operator? You know, how's your communication? Like, what they'll ask the right questions for themselves because they're more sophisticated than the normal investor, right? Even though we now call the normal investors sophisticated, but they're really not. You got to sophisticate them. Accrediteds are already sophisticated. All right, go ahead, Roberto.
Hey, how you doing, man?
Good.
Yeah, I just want to share a little something. It's great to get all tax benefits, with you know, with that status, the 750 hours. But I hear a lot of skepticism from people saying, "Am I doing the right thing? Uh, should I watch what I'm saying? What am I limited to?" So if you're not a licensed realtor in the state of, in my state of Florida, um, you're basically you're basically allowed to buy your own properties. You can't sell them, right? You can't sell somebody else's property. You can buy your own and sell your own, but you can't sell others.
Mm-hmm.
Okay, you can do all that without a license. But and I used this book by Bird Rogers, okay, which is it covers a lot like understanding real estate mortgage fraud, working with real estate investors, um, from contracts to closing, okay, impact of gentrification on real estate. So it covers a lot of points that would take maybe some skepticism, right, when you're talking to people, is to say the right things. I mean, you can study the whole book, and
You got to bring the book closer to your body.
Okay. So, and it's a simple book. And if you look up, and I can share the link, okay, and there's sections like $9, $10, okay. But the knowledge that's in these books, okay, will encourage people to say, well, I'm afraid to talk to anybody. If they ask me the question, and I don't know, I'm going to feel stupid. You know what I mean? Just knowledge is power, right? So if we can maybe share some of these books, and you can buy them, like I say, $9, $10, $15, but it covers the basic substance of it's continuing education. It's not to get yourself for a license test per se, right? But if you want to do that, that's your choice. But it has a lot of the language, and it covers a lot of the issues and how you should, what to look out for.
Mm-hmm.
As long as you know those basics, at least, you can say, yeah, I'm a real estate professional, but shouldn't you know all the basic terminology of real estate? Not just going through and getting the hours in. I'm saying you should learn all the basics, and so when you speak, you can speak,
Yeah.
with confidence.
That's up for interpretation. I'm not going to say people should or shouldn't, because there are plenty of real estate professionals that don't do that don't want to do anything with it. They don't want to know how it's done. They just want to be an investor, right? They got money and they need to save on taxes. So what they do is they spend the time looking at if the deal is a good investment. They don't need the lingo. They don't need the lingo of GPLP, or they don't need the lingo of, all the things in the mortgage world and all of that. They don't need any of that. They just need to analyze, study returns, and then how can I not pay taxes while I'm doing all that, right? So that's a real estate professional there too.
Yeah, but that's for investors. But people are just starting out to know the basics. You know what I'm saying? I'm talking about that, not educating a buyer or an investor, because they should know what they're doing. If they're investing $1 million, $5 million, whatever, you don't have to teach them anything. They already know how to do it.
Yeah.
Just the basics.
Can
My
you share that title or link in the chat?
Yeah, I can. Like I say, it's a lot of basic language that you can just learn about, and laws and ethics and stuff like that. Things you can say, you shouldn't say. You know what I'm saying? It's just a good idea to have. That's all.
Yeah, stick it in
You
the
can read
chat, the name
anything,
of the
any
book.
books. Just happens to be the one that I was working on. That's all.
It's fine. Stick it in there.
Yeah.
That could be somebody's money worth moment right there.
Right.
Mm-hmm.
Okay.
Right. Cool. So,
Cool.
I think this was an important conversation. Like for me, like I kind of understand. I feel like I understood all of it. And when we were talking to my CPA on our Tuesday night call with the team, questions came up, and I was confused in certain parts, and I was like, whoa, what? I just learned this. I didn't know that a non-real estate professional can take their passive losses from a deal to offset their capital gains if it's in the same deal. Like that's huge. That's a really big thing to know. I didn't know that. I thought I was just like, I'm going to avoid any of that problems just by being a real estate professional, because I'm going to make sure that when my capital gains come, and it doesn't have to be real estate capital gains. If I'm a real estate professional, I can make $1 million trading a Tesla stock and go and invest $1.4 million in real estate. And now my whole $1 million I gained from stock is offset. Crypto, stocks. That's why real estate has to be in the equation. Like people are just they don't get it. And so we get to educate people. We get to bring this knowledge out more. Right? I just found out you can 1031 automobiles. That's funny. I didn't know you could do that. Right? But I mean, why would you even need to 1031 automobiles? Like cars depreciate in value, really. I don't know very many cars that gain value over a period of time. Yeah, but you could take 100% depreciation of a car, though, an investment of a car. You invest into but you invest and buy a Lamborghini, and that's your rental car that you rent out on Turo. Year number 100% depreciation on the entire cost of the car. That's pretty cool. Yeah.
Did you say that because I didn't think we could do this, that if we have capital gains from selling stock or fund,
Yep.
that's passive, but is that really, can we use that as passive income? I thought only rental income.
Well, that I'm not saying that's passive. I'm saying that's capital gains. But
It
as a
is.
real estate professional, I can offset that income. A non-real estate professional, I
Okay,
can't.
okay.
I could offset the dividends that's paid out to me. I could offset other rental incomes, right? That I may have in other properties. Because
Right.
my losses is already used up for one property, and I've held the property for so many years, 10 years, 15 years. Now I got all this cash flow in this property. I can use the syndication deal, that K1, as a non-real estate professional to offset that passive income. Yeah.
Okay.
So it just works for all passive incomes. And if you don't use it, you don't lose it. You keep it, and you just keep it rolling till next year. And then maybe next year you'll get a property and you'll be like, yeah, now I really need real estate because I want some passive income that I can not pay any taxes on. Right? Because I like, if you get $5,000 and you don't pay any taxes on it, it's actually really worth like $8,000. It would take you $8,000 to make 5,000 or 6,000. But if you get 6,000 without having to pay taxes on it, that's worth 8,000. Now you're saving time again, because it would have taken as many whatever new hours you needed to make up the extra 2,000, so that you can give it to the government and only make 6. All right, so investing is about saving time. Okay. Other thoughts, other questions? There are no stupid questions. You know, like always always have a beginner mind. That's one of the keys to success. Like literally when I'm interviewing people, I'm like, wait, so tell me how does this start? Even if I thought I already know the answer, I still want to know from their perspective how it's done. You know, and then sometimes we're like, oh yeah, that's exactly what I thought. Awesome, cool. Right? Like it's awesome, it's cool to be a beginner. Always. And Liba's the best at this. Go ahead, Liba.
Hey, I know I'm a beginner of life. No, I'm just kidding. I just wanted to clarify something. I would never do anything illegal. Like,
Oh, yeah. I know.
I just wanted to make sure because I don't know most people on this call. So I just wanted to throw that out there.
Oh, well, thank you. Appreciate that. Now, I don't know
Yeah.
if I could say that for myself. I don't know. I don't know. You know,
Also because,
I may smoke weed outside where they tell me
oh,
I can't.
I meant, you know what I mean.
I know. I'm just kidding.
Also, they audit travel nurses all the time. Like, people don't realize it. It's a field that gets audited so often, it's crazy.
Yeah, and it's messed up because you guys literally are at the front line, risking your lives and really contributing to society. And like, I feel like they punish people that work hard. It's
Yeah.
you know.
Oh, I have a question actually. When you say you put your flights and everything, do you actually save receipts or you could just show it off the bill
No,
or a
I don't.
statement or your,
So because when you have this like real estate professional status and you know that you are it like 100%, I don't even save any receipts. I'm like, here's my credit card statements. This is what I've done, and this is, I actually don't. I mean, maybe I should, but I don't. You know,
do you have
I,
a specific amount that you write off
no. So I have
for
specific
flights?
cards that I use, and everything on those cards are write offs. Like I know what's a write off, what's not. And like I won't go to the grocery store and buy things on those cards and try to write them off. Like I wouldn't even think about doing that. Or like going, you know, but I
Yeah.
have recently put my haircuts on those cards.
Well, you
You know,
should. You gotta look good for your job.
exactly. Because, and Ryan Pineda actually gave me that idea. You know,
He's
he gets a
awesome.
haircut once a week. So I'm like, I'm gonna get a haircut once a week and I'm gonna put it on this card because it's part of my business, you know? So
So you could, that is so interesting.
mhm. Like more
Okay.
options open up to you when you are just a an investor, a real estate professional. Like when you're in this game, you just like the doors just keep opening for you. And everything is a gray line that you can actually stand on to make a case for yourself. When you are locked into a W-2 job and you're doing something important for the community, the way that they keep you doing that is they tax the crap out of you and like hold you in prison. So you got to keep doing that job.
That's why I started working. Yeah, like you gave the example with the 100K with getting back 70. It's more like out of 100, I paid almost 60K on 130K.
Yeah, I mean I just think that's so
Disgusting.
messed up. I think that's really messed up. I see my sister, I see my brother-in-law, and they're stuck in it. They're so stuck in it that they can't even listen to the words that are coming out of my mouth.
Because it's
Like
hard. It sucks and it's hard to get out of it.
I know. So I don't know how I can do it besides doing these calls and just speaking about it over and over and over again until somebody gets an aha moment. And that's my I feel like that's my calling. Just got to do it. Fear
You're
is the
doing
ultimate power.
awesome.
Yeah. Yeah, thanks. Um we are going to start moving these calls. I mean, they'll still be, always on like this, but we are going to start moving the community into a really cool place that we're building. And it's really exciting. I'm excited for it. Great partnerships that I'm creating, and it's going to be a really badass community. We're going to take Facebook, WhatsApp, all the stuff and put it into one place. So just wanted to put that out there. Okay, any other questions? I just want to share, for anybody that's like, well, I don't know how am I going to get into a deal. I'll just draw a couple scenarios in which we can do that. All right. So, um, well, first, get into your first deal. Let's say like I have no money. I got no money to invest. I got no zero time to invest either. So that's out, that's out. But I've been sitting on Alex's call for like, 6 months, 5 months, and I finally got my aha moment, my courage to go and do something. So I do have experience, and I do have mentors, and I do have a network, right? Like this is what's available for you on these calls. Doesn't require any money, infinite possibilities being on them, right? It's not just my calls, a lot of other people providing amazing, great information. Yeah, 2023 deal. We need to be looking at deals. We need to look at deals and we need to be able to underwrite them really quick and decide, how do I get into it? Okay, so number one is some sort of seller finance that carries the entire thing. Okay. So one of our mentees in our group just got a deal, $0 down. Okay, all the fees and stuff is probably like $250, something like that. But you can, let's say the property has, let's say it's worth $200,000. Okay, it's worth 200K. It generates $2,000 per month. This is called the 1% rule. First of all, this is called the 1% rule. Is it the 1% rule? The 1% rule should be, yeah, 2,000 a month. Is 2,000 1%? Yeah, it is. Okay. So it's called the 1% rule, which means your monthly income is 1% of the purchase price of the unit. If you ever find a deal like that, immediately begin to figure out how you can take this deal down. All right. Because kind of rough estimates. All right. Every $200,000 of loan, okay, is equivalent to, with everything, somewhere around like 1,100 a month in payments, maybe a little bit lower. Okay, it's depends on the interest rates you get and all the other stuff. But let's just say it's $1,100 a month is a loan. Okay, well let's just let's just write this out. Okay, we'll take this out for now. That's too much of a. We'll take real scenarios here. So if you can go to a seller that's got the house paid off, and there's plenty of these people out there that have owned properties for a long time, it's either fully paid off or mostly paid off, and they just don't really want to deal with it anymore. And the property is generating, and they're making, let's say they're making, okay, because they haven't increased the rents or done anything, and right now they're making somewhere around $1,200 a month. And you can say, hey, can I continue to give you $1,200 a month and just take over and operate and run your property? It's kind of like, let me manage your property, but you're really doing some sort of seller financing. Okay, you ask the seller, in 7 years, 5 to 7 years, I will buy your property for 200K. And for now, I will continue to pay you $1,200 a month that you were making on this deal, but you no longer have to deal with anything. I do it all. Yes. So lease option is another option, which we can talk about that in a second. You and I went to Chris Crone's conference. He taught a lot about that. I actually went and did it. It's actually pretty cool, but it's too slow for me. And I like to actually, get the depreciation and all that stuff off of it. When you do a lease, you can't do a depreciation. Like I need tax write-offs more than I need cash flow. So, one of the first things actually is you got to decide what is your goal and objective when you're buying real estate. Do I need the cash flow, or am I looking for the appreciation, or am I looking for the depreciation so that I can write off taxes? You got to know your own goals. All right. On this deal, you can say the same thing. I put no money down. I'll pay you $1,200 a month, and I take over the property. Now you're making $800 a month. Now, of course, you tell the person, hey, like anything goes, anything under $1,000 that needs to be repaired on the property, I will repair it. But if the roof goes or something else goes, I want to kind of like a deduction to the 200K. Or maybe you don't. I don't know. It depends on whatever you think the how the deal is, because maybe the deal is worth $280,000. And in 5 years is going to be worth 400, and you're locking it in for this. Even if you break even, this is a good deal to own. That makes sense? Now that's one way to do it. You can also say, hey, $200,000, I'll pay you 5% interest every month or every year. So that's $10,000 divided by 12. So I pay you $833 a month. You don't have to do anything. You're just carrying on this loan, and then we will agree to a payment, sometime. A balloon payment, 5 to 7 years. I don't pay any interest rate. I don't pay any principal to you, but I will pay you the interest. And then when the time comes, now you have a deal. If you do this 5 times, 6 times, 7 times, if you really committed to it, there's no reason why you can't do 5 of these this year. Now, the question is, how do we actually find these deals? Right? There's a lot of resources. You can go to the city, look for distressed properties, look for people that are behind on their payments for their taxes, which a lot of people are. You can look at properties in which there are things that are left neglected, grass not being mowed, the side of the yard having. So you can look at in the county taxes, or you can drive around and literally find these properties in the neighborhood where it looks like they are not taking care of it. It means they're probably having some financial hardship. And you can come in and offer something. Now, let's say you can get a deal for such a great price, right? This deal, maybe you can get it for $250,000, but the seller just really needs $50,000 right now. Okay, it's a great deal. It's worth $430. If we fix it up, $450, something like that. There's other strategies. Then you go, hey, Alex, I found this super sick deal, and we underwrite it. We look at it. We look at the market, but we just need $50,000 to get this under contract. And the seller will hold the rest of the money. We don't got to go to the bank. We don't got to do anything. We just got to come up with $50K, draw up a contract with our attorney, done. All right. So then you just raise the $50K. So that brings us to option number 2, which is different types of partnerships, which is really what multifamily is about. But so you bring partnerships, and I think understanding this types of deals really is the foundations of doing multifamily. So it's called JV, okay? Joint venture. Or junior varsity. No, joint venture. This is how I did it. When I got back into it, we had it was a $310,000 property that we bought. And, I was like, I didn't really have partnership experience, and I didn't really, I thought like raising $100,000 was too much, or 70,000. So I worked it out with a partner. I was like, hey, we can do this deal. I can do certain types of returns for you. And all you have to do is qualify for the loan for a second property, like an investment property, 10% down. Okay, so he ended up putting somewhere around 43K down with all closing costs and stuff. And I said, we're doing Airbnb, so we need like another 7,000 for furniture. So he gave me another 7K. And then I'm like, and because Chris Crone taught me this, I need another $5,000 in the bank account for my sleep well at night type of thing. I followed it exactly to the T, what I learned from a mentor. See, like if I just learned it and did nothing, it means nothing to me. But what I learned from Chris Crone, I took it and did exactly what he told me to do. And then we got this deal. He ended up putting like $55,000 all in, right? And we already cashed out, refinanced this house, and his 55K went out and into another deal that we're doing. And then in the bank, we have $33,000. Now, Chris Crone also taught this, which I actually don't want to do now, which is if the investor leaves their money in the account, then we leave our money in the account in the deal. So I don't know why when I mentioned this, all of my initial first partners like, yeah, I don't want the cash flow. I want to sit in the account. I'm like, okay. So now we have this $33,000 sitting in like we have about that much sitting in a bunch of different deal accounts. It's weird. After he did that, all of his deals, he just wants the money sitting in the accounts and waiting for the next deal. And then the people that he brought on, that he introduced me to, also did the same thing. And now when I do any deals like that, I don't want people to I don't want people to leave the money in the account. I want it to be distributed and used. I want people to have the experience of passive income. I don't want them to see it like it's just like a 401k account. I want you to know what it feels like to have a check come to your mailbox every month, every quarter, or something like that. Well, he says it's for possible repairs. It's just sleep well at night, right? Like if anything comes up, I don't got to come up with money out of pocket and I'm not going to do a capital call. See, that's what a capital call is. A capital call is when a deal is stressed and it needs an injection of money. And I got to go back to my investor and say, hey, we need more money to go into the account. So from there, I learned what we need to do to not have a capital call, right? So it's the reserves. And in our real estate multifamily deals, from the beginning, I had that foundation. So when we raise for the deal, like on our Vegas deal, we could give a bigger return to our investors if we raise just enough money to close and keep 20,000 in reserves. Yeah, we could do that. You get another extra 0.7 or 1% returns for all of our investors, but we were raising an extra $250,000, which is almost like 10% extra. It's 10% extra on top. But the deal is going to be safe. We aren't going to ever be doing a capital call, right? Because of how much we have in reserves. All of our deals, like our Fort Pierce deal, is almost over $300,000 just kind of in reserves. And all of our deals, over 100K in reserves, every one of them. So that's just kind of how I do it, and you learn the foundations from doing small deals. So I do encourage people actually to just if you've never done a deal, like you can do it. You can do it. And if you're like, I can't invest money into a syndication this year, sure, do this, right? Do this on the side, get that done, and then figure out how to become and be valuable to a team. And then now you're going to do multifamily. And I've shared this before. In multifamily, there are lots of roles that you can play to be a general partner. A general partner is basically the managing partner. You see, on this deal that I showed you before with my first investor, the deal was this. You put the money in the contract, it says 57K is your contribution. Whenever we sell or refinance the deal, this goes to you first. The links are not available. I'm not sure what that means. 57K will exit you out first, but anything that I make for us is a 50-50 split. all the cash flow is 50-50 split. Any refinance on top of this 57,000, 50-50 split. And that's what I did on over 12 properties within like 2 years. Okay. And great returns. People were happy with it. Okay. Chris Crone taught me this method. Now, coming into multifamily, it's like because there are acquisition fees, there are asset management fees, disposition fees, all of these things where people need to get paid, which it makes sense. Like if you're going to quit your job and do it, you get paid. Okay, do it. I considered it in the beginning, I'm going to take no fees and do a 50-50 split. But then I was walked off that cliff because they're like, yeah, nobody's going to invest with you. It's standard practice to have fees. I'm like, fine, do fees. We'll do fees and we do an 80-20. We'll do fees, we'll do a 70-30. Right? Because it's really a lot of work. Like when you're running a deal, it's a lot of work. There's nights that I can't sleep. There's phone calls that I've gotten late at night. You know, now when you do multifamily, there's a lot less of that because you can actually afford a real management company. No single family, duplex, triplex, quadplex, 5, 6plex that I've ever owned, I could ever have afforded a management company. It was always me managing. Okay. And now that we've had a collection of 12 houses here, we have like and they're Airbnbs, which makes it like even more work. We have 12-person team that handles all this. You don't even need a 12-person team to handle a 200-unit deal. We got 12 people handling 12 properties. So as fast as you can, graduate to multifamily. Okay, take your skills from the smaller deals, learn them as quick as you can. Know that those deals you're not trying to get rich off of. Those are your stepping stones and your classroom so that you can do multifamily. And then once you do multifamily, there is no other games to play. Telling you, I've played a lot of games, and you know, multifamily is the only game that people should be playing. Personal opinion. Roberto, hey.
All right. So I want to go back to the first deal you put on your board, right? So when you have an equity partner, so the question is, let's say it's a $10 million deal. Equity partner, the owner stays in owner financing for $5 million, right? How is that viewed from the bank? Is that considered your part of your down payment?
So you got a $10 million deal.
Owner financing of 5.
Okay, owner financing 5 million.
5 million at 4% interest, whatever, 5-year balloon, typical stuff.
Okay, yeah.
So he's out in 5 years, but it doesn't matter. So the initial loan, when you go to the bank, okay, now you have to borrow 10 million.
You don't go to the bank for anything
to close.
No,
No, you raise 10. What do you do?
Raise
Okay,
5.
So your thoughts.
You raise 5, and the seller holds 5. You got to raise the other. You don't even go to the bank. These types of deals are great because you don't need to deal with the bank. You don't need a loan. You don't need a balance sheet guarantor. You don't need any of that coming into the deal.
Okay, but what if? Okay, let's multiply that times. What if it's $100 million deal?
I don't know who's going to be holding. I don't know who's owner financing $50 million deal.
I got one. I'll share it quick.
Okay, so let's go. $100 million deal.
50 million owner financing at 4%.
Okay.
5-year balloon.
Uh-huh.
How do you go to bank with that? Do they take his 50 million consideration as part of the down payment?
No, so you don't go to the bank anymore.
Again,
what you need,
but
you don't go to the bank because you can't go to the bank because the bank wants to write you their own loan. They don't want the seller writing a loan unless you can ask the seller to be second position to the bank, which the seller would never do.
Right, that's the problem.
Yeah,
bank was first all the time.
Yeah, bank will be first all the time. So what you need to do is you need to get some sort of other private equity. Okay, that will cover, I don't know, write you a $30 million check right? And then now you
Come
need
up
to
with
raise,
20%.
you need to raise 20 million.
20% down payment, basically, and they give you private money at 30.
It doesn't have to be that. You can literally have, they can, if the deal is good enough, they'll write
Mhm.
you a $45 million check and you just got to raise 5 million.
So, okay, so then how are they protected? They take a second?
Yeah, they're second. They're
They'll take a
second.
second.
So they're second. And anytime, if they write a check this big, anytime that they want to take over the deal and they're not getting their pref returns. See, the
Yeah.
really cool thing about this deal is this private equity will not want, they're not going to want the upside, downside, depreciation, nothing like that. Right. So they're going to want, I don't know, 8%. 8%
Okay.
pref. That means probably no investor in this 5 million is getting any distributions. Okay. All of it's going to go here. But on $100 million deal, if this deal becomes, 120 million, you're going to make big returns for your investors. You're going to make
Right.
you're going to make 300% returns for your investors. Right? And all it's got to do is go from 100 million to 120, which all that takes is for the interest rates to go from 7% down to 4%, and now your property is going to be worth 120 million with doing nothing.
Or if there's a $200 or $300
Yeah.
upside.
Rent, yeah, or the rent increases by $150,
Yeah,
or whatever,
well,
$200, something like that.
well, it's a 507 unit deal, so that adds up pretty
Okay,
quick.
so
The
570
equity goes
unit
up
deal.
quick.
Yeah, okay, let's say the rents go up by $100. So rents increase by $100. So you take $100 times 570 units
Times 12.
times 12. That's 684,000 extra dollars you're gonna make a year. 684K per year. That's just added to your NOI. And $100 million deal, 500 something units.
What do you think the cap would be on that?
Wait, hold on. So 570 units divided 100 million.
So if it was a 6 cap, the property
So it's 100,
has,
it's 175,000 a door. On 570 units. I don't know. What is this? A class B?
is C plus.
C? Yeah, C, CB,
It's
something like
value
that.
add. Yeah, it has value add.
Okay, so I don't know, 6 cap.
Yes, I figured 5.5 or 6 cap.
Yeah. So 6 cap, 684,000 divided by 0.06.
If you raise the rents,
that's 11.4 million increase in value.
Immediately year one that you raise the $100 per room, which is great.
I mean, so
because a number unit makes a deal. A big unit.
So this is a little more advanced for some people that are here that may not be that advanced, but cap rates, value equals NOI divided by cap rate. NOI is your net operating income. By increasing $100, you probably don't have to increase any expenses. So this is just going straight to your NOI bottom line, most likely something around that, right? So you take your NOI divided by the cap rate, which is, what is the cap rate of the property? Usually the lower the cap rate, the better the location and the better the quality of the asset.
Right.
Okay, so lower the cap rate, higher the appreciation. So the lower this number goes, right? So if the cap rate was 6%, is a 6%, that's 11.4 million. Now, if we took 684,000 increase on, let's say, a class A deal that might be 4% cap rate, you divide that by 0.04. Now that's a $17 million increase. That's a $6 million difference just by changing the cap rates. All right, so this is obviously going to be more advanced, but what you're going to get on this deal, okay, so because they're not participating on the depreciation or the upside or the downside, so all they care about is getting 8% on their 45 million. When you sell the deal, even if you sold it for 200 million, all they want is their $45 million back. Okay, they're not participating in the upside. So now The people in the 5 million is participating in the upside and the depreciation. So they put their $5 million in, they
You get
get
all the benefits.
$50 million of depreciation. Okay, which is stupid.
That's what, yeah.
So now you invest in this deal, like you put $100,000 in and you're getting $1 million in depreciation. That's kind of insane. Right.
Crazy.
So like anybody would invest in this deal, doesn't even matter what the returns are. Just for the sake of taxes, you put 100K in to save. I don't know if it's $1 million, maybe it's 500,000, but either way, like Brad Sumrock had a deal last year like this where you put 100,000 in, you get like $230,000 in depreciation first year because the private the mezz debt that they were putting on there did not participate in that.
All right.
Right. So upside downsides of that, they take control of your property as soon as any sign of trouble happens. All right. You don't really have control of your property. Now you build a good rapport and good relationship with one company for a while, then they may give you a little more, you know, more room to run.
Yeah, we'll talk about this deal offline. I'll have to call you tomorrow.
Yeah. All right, cool.
That's
so
cool.
Yeah, I actually met somebody that has 750 million to buy anything cash as long as we give them the construction work.
The construction work. I'll have to give that part up.
Yeah.
Just to make the deal. I'm good with that.
Yeah, whatever, you know, and they'll invest a lot of that money back into the deal, and also they'll give referral fees of $200,000-$300,000 depending on the size of the deal.
Yeah, sometimes half of something's better than nothing, as they say.
Hey, you know, if I can just make introductions and get $400,000-$300,000, I'll do that all day.
Sweet.
Yeah.
All right, cool. Thank you.
Yeah, of course. So hopefully that was you know, helpful. And you know, we'll do this again later. We'll do this again next week. But I appreciate you guys all being here. Look out for an email for the new community platform that we're building. And you know, reach out to me if you guys ever need any support or anything. I'm here to help. I got some time. All right. So that's it. That's all, folks. Take care, everybody. Appreciate you all. Thank you for
Thank you, Alex.
time. Talk soon.
All right, thanks, Alex.
Take care,
Thank you,
everybody.
Alex.
Give me a call tomorrow if you have
Great
something.
call.
Bye.
Yeah. Sounds good.
Hey, thanks, Alex.
Thank you.
Thanks, guys.
Thank you, Alex.
Good night.
Bye.
Night.